Thanks everybody for joining us today. I have a few slides to go over, and then I'll be joined by Samir and Caitlin to provide more detail. I apologize for the a lot of data on these few slides I have for you, but fortunately they're just a few slides. So let's get going. So obviously the objective of this webcast is to look ahead, not look back, but I can't help but quickly look back and draw some observations and conclusions for you. So what I'm showing on this page is a table that shows different asset classes. If you look at the first column, I show public and private asset classes. And I show calendar year returns over the last 5 years. The 2024 returns are basically through December 13th. They may change a little bit before year end. And a couple of them, particularly the private asset classes, are lagged a quarter, or in one case, a couple of quarters. And then in the second to last column, I show the 5-year annualized return. So let's just focus on private debt. So third from the bottom row, let me describe what I see over the last 5 years. Let me start, however, with the actual 5-year return, the intersection of the two red ovals, 9.6%. That's the return over the last 5 years for the Cliffwater Direct Lending Index. It includes an estimate of 2024 of 11.7%. So 9.6% is interesting because the yield on the direct lending index over the same period was 9.8%. So just a tad below the yield. And that's what I've said. Ultimately, the return on private debt is equal to its yield minus realized losses. So that equation basically worked out over the last 5 years. If you look at the individual year returns, they're also very close to the 9.6% average. Some years like 2020 and 2022, periods of market risk, market dislocation, either COVID or the rate hike period, basically return was slightly below, around 3%, 4% below the yield, average yield. In other years, what I call recovery years in 2021 and 2023, and including 2024, basically these were recovery years where returns were above the yield. So basically, the private debt has been and continues to be, in our opinion, very predictable asset class. And if you look at the deviations year to year, it averages about 3 to 4%. And that's basically our estimate of standard deviation or risk for direct lending. So really, all of that makes sense to us. If you let's look at another asset class. Let's go up to stocks in the first row. Okay. Here, it also makes a lot of sense. The 5-year return, annualized return, 15.2%, has been an excellent 5-year period that includes 2 drawdown periods. But basically, 15.2 is consistent with the cash yield plus growth over this period. Earnings per share growth over the 5-year period was about 11%. And if you include cash yield, including dividend and share buybacks, that's about 4%. So the 15.2% makes a lot of sense for a 5-year return. But you see a lot of volatility year to year. Obviously, stocks are much more risky. Shareholder perception has a lot to do with future growth, and so the volatility estimate on stocks or the S&P 500 is more on the order of 18% rather than 3% for direct lending. Let me pull out one other. Let's go to levered loans. So about in the middle of the table, levered loans for the 5-year period, 5.9%. And that's exactly what the average yield was over that 5-year period. But notice significant volatility year to year, much more so than private debt. And as I've argued, a lot of that volatility has to do with the liquidity factor in levered loans, which is priced very differently from period to period. So yield is important. Basically, the long-term for fixed income classes or credit classes, basically expect the yield minus whatever realized losses there are. But period to period, year to year, you're going to see some volatility, but really very little in the way for direct lending. So let's look at 2024, what we've forecast versus the actual. So this is a graph, amended graph from this time last year, where I basically forecast that direct lending, private debt would return its yield. And at the yield at that time was about 11%. We had factored in 1% in realized losses, little offset in unrealized gains. But basically, we said 10.55%. If you look at the bottom of the page in the ovals, gray ovals, we show what we think the actual will be for 2024. The actual will be around 11.08% in terms of the total return, so a little better than our forecast of a year ago. So why were we a little bit conservative for the year? Well, basically at a couple things. One is the SOFR, or the reference rate. We had forecast 4.75. Basically, it was higher for longer, and the actual average SOFR rate over the last year was 5.27%. So basically, the realized return came in about 0.5% better due to higher SOFR over the course of the year. Our credit spread came in about as predicted. The other factor was realized losses. Our realized loss rate over the last year, 76 basis points versus our projection of 1%. Basically, the economy was on average a little bit stronger than we had anticipated. So all in, I thought it was a pretty good year of predictions, 2024. Really no big surprises during the year. And so the actual return for the year of 11.08% was really very close to the going in yield of 11%, the SOFR plus the credit spread. Go to the next slide. So what is our forecast for next year? First of all, the headline is, it will probably, don't be surprised if we have a sub-double-digit return for 2025. Our forecast is 9.30%. That's comprised of the components on the left. So SOFR, we just had a Fed cut today. Our SOFR forecast for the year is 4.05. Samir tells me the forecast is for a couple more cuts in 25. That means we may do a little bit better than 4.05%, but I think that comes off the forward curve. I think that's a pretty good estimate. Credit spreads are in versus where they were a year ago in the prior page, I had used, I'm sorry about that. I had used 6.25, okay, last year. So this year I'm using 6%. So a decline in spreads. Realized losses, we're expecting a little better this year, minus 75 basis points. You remember last year it was 1%. The economy is ratcheting forward at a very good clip. I'll talk more about that a little bit later. So we think realized losses are going to be below the 1% historic average. Unrealized gains and losses, these are markups or markdowns. Really, we don't expect anything material in this category. Basically, private loans are trading pretty close to par or cost. So unlevered, gross of fee, our total return, add that all together, and hopefully it adds up to 9.3%. Let me talk about leverage. We've been talking about unlevered gross of fee. I just want to price for everybody what leverage for 2025. Okay, so again, the credit spread is 6%. Okay, if we use leverage, basically SOFR cancels out. Everything is priced over in a leveraged account or in a financed investment. SOFR cancels out. So we're left with the credit spread, 6%. Okay, we're expecting losses of 75 basis points. Okay, the cost of debt, again, above SOFR, I'm using 2.25%. That includes administrative fees. If you take out administrative fees, it's more like 2%. Some people can probably get a little bit below that, but I think it's a reasonable estimate, at least for a private fund, maybe lower for a perpetual 40 Act vehicle. So subtract the 225 and the 75, you get 3% net spread. Subtract carried interest. I'm making an assumption that fees, management fees, are not charged on levered assets. Some cases they are, but we would levy a 15% carried interest charge. Generally, if management fees are applied to financed assets, it's a 10% carried interest. So not including that, using the 15%, that's 45 basis points in carried interest. Subtracting that from 3, get 2.55%. So my takeaway here is, gee, if you're in an account that's 1 times levered, and let's say the fee on the unlevered assets is let's call it 1.5%. So if you went to the my prior chart here, subtract 1.5%, and you get basically high sevens, 7.8%. Add the 2.25, and what's that math? You get a double-digit return. I can't do that in my head, but basically, that's the configuration. If you have a low levered, half a turn of leverage, 2 turns of leverage, that's the math you can do to take the 9.3% to adapt it to whatever strategy you want to implement. Let me talk about risk. I apologize. You probably haven't seen this graph before, but let me try to explain it. So here, I'm just looking at drawdowns. Okay, so over the last 20 years, I'm looking at quarterly data, and I'm just looking at downside. Okay, And I start, and the purpose here is to say, hey, what asset classes have the greatest probability of downside and severity of downside? So let me start with the heavy diamonds, heavy black diamonds displayed on this graph. They represent the Cliffwater Direct Lending Index. So basically unlevered private debt. And if you notice here, the horizontal axis is time, 20 years. The vertical axis, again, downside, this is drawdown, okay? And just by definition, drawdown is what's called the cumulative drawdown for an asset class from its peak, okay? So it's not a quarterly negative return. It's the cumulative, at any point in time, what's the cumulative negative return from the peak? So let me start with the direct lending index, the diamonds, several observations here. So basically I've plotted 5 asset classes and a couple things. One is there really been only 4 drawdown periods for direct lending. The first is during the financial crisis. If you look up at April of 08, basically you see three diamonds, black diamonds. The first 2 quarters represented basically very small drawdown. And then the fourth quarter of 2008 hit, and the cumulative drawdown was minus 7.73%. Okay, so that is the worst case for the Cliffwater Direct Lending Index. And at the time, looking at managers' numbers, basically for unlevered accounts, that was pretty much what their numbers came in at least on average. And then subsequent to that, there are 2 mini drawdowns or mini recessions during the following decade, very small, less than 1% for direct lending. And then COVID was the second hit, minus 4.84% for direct lending. We call the 2008 a 3 sigma event, 2020 a 1 sigma event, and those other 2 are basically half sigma events. So basically, the drawdown in direct lending measured by the Cliffwater Direct Lending Index is single digit, fairly infrequent, as I'll show you in a second, and the severity is very, very modest. Okay, let's go by comparison. So let's look at the Russell 3000, the blue dots. So if you look at the financial crisis, you see this progression of blue dots starting on the left-hand side, blue circles. Basically, there were kind of very small drawdowns prior to 2008. And then 2008 basically catapulted down. The Russell 3000 fell, its drawdown was almost 50%. Okay, then it started to recover, and by 2010 it had fully recovered. Then there were subsequent drawdowns. So remember the Euro crisis in 2011, the oil crisis towards the end of that decade, 2018 and 2019, pretty severe drawdowns of 20%, and then COVID, the drawdown was 25%. So basically, on a relative basis, direct lending provides tremendous downside protection vis-a-vis stocks. Let's look at it against regular bonds, investment grade bonds, the Bloomberg Aggregate Index. That's the triangle, the gray triangle. Again, for the traditional investment grade bonds, very few drawdowns were infrequent and very small, low single-digit drawdowns until the interest rate hike, until inflation hit, and the Fed put on the brakes. Interest rates went up, and or their value went down, and stocks went down at the same time. So if you look at the right-hand side, we had unprecedented drawdowns in investment-grade bonds. Treasury market sunk, and basically correlations went from negative to positive. Also notice during that period, there was no drawdown in direct lending. Okay, there is no interest rate sensitivity and very little equity sensitivity in direct lending. Consequently, there was no drawdown. Now, let me just draw comparisons with liquid credit, if I could, using the Morningstar index. That's the green dot. Okay, if you notice that green dot, let's go back to 2008. Basically, the drawdown was quick and got to minus 30%. So you give up on yield doing public credit, and you take a whole lot more drawdown risk. So we saw this also, particularly during the oil crisis, okay, and during COVID. Drawdown in COVID was almost 15%, and during the last interest rate hike, it wasn't as severe, but it was meaningful, minus 5%, whereas direct lending had a positive year. I think about 6%. So anyway, my point here is volatility, particularly downside volatility. Bad things happen. They're not, at least I know of no one who has a crystal ball and can predict these types of negative events. And it's difficult when we put our forecast together to say, hey, bad things are going to happen. But I think this is a useful exhibit to illustrate, hey, if bad things happen next year, what's my downside? And my conclusion is, a lightly levered private debt portfolio, you might have losses, but they're going to be single digit depending upon the severity of whatever happens. And quite in contrast with, let's say, a 60-40 portfolio, which would probably be down minus 15 to 20%. And these other liquid credit instruments would also be down at a level similar to a 60-40 mix. So my point is, hey, there's a lot of safety in private debt. So, if we miss a forecast in terms of risk, just know it should be, on a relative basis, attractive relative to all other asset classes and pretty modest. So I talked about our projection for private debt. I talked about, hey, if we're wrong and bad things happen, what might be the severity? This is a depiction of what others expect on a go-forward basis. And I've shown this graph before, and basically it's the return and risk projections averaged over a dozen kind of higher profile large allocators. The Blackstones, not Blackstones, BlackRocks, the Callens, the JP Morgans, et cetera. I think we provide a list at the bottom here. But it shows clearly that we're not too different from the other allocators in terms of our forecast. They're forecasting 8.6%. Okay, we're forecasting I think 9.3%, I think. So that's about a 70 basis point difference. I think it is 70 basis points. But observe that their forecast on cash 3.42 is lower than our forecast on cash of a little over 4%. So it adjusted for kind of where the consensus thinks cash rates are going to be and where we think they're going to be. Basically, our private debt is pretty much aligned with what the consensus is for amongst the large players in allocating assets. With that, I'm going to just one more slide. Let me just make some brief comments and then pull in my two elves here. Looking at trends for 2025, it really looks pretty good. It's really hard to find big negatives here. The most important is expected GDP growth, depending on who you're talking to for 2025, is 2 to 2.5%. It's it's not 3, but it's a pretty good number. It basically means we're going to have tailwinds. The expected S&P 500 earnings growth next year is 20%. Pre-election it was 17. Basically, with the way the votes went this year, S&P growth estimates have bumped up year over year by about 3%. So in other words, that's good news. We're already into rate cuts. So basically, we were expecting before this today's cut 1% in rate cuts in 2025. Again, Samir said there's going to be a couple others, so maybe it would be 75 basis points, not a full 1%. But basically, rate cuts basically hurt our yield. As you know, not immediately in the case of private debt. Generally, these reset every 3 months, so there's a lag. So we benefit from that, even though rates are coming down. Two other things are good news. Basically, if you look at the market today, we have low accrual rates. I think our last print was 1.3%. The historical average is just a little bit above 2%. We also have low loss rates, actual realized loss rates below 1%. The historical average is 1%. Probably the three questions I always get asked, which I always tend to pass on to my elves here, is one, the focus on PIK and where it stands today. We publish every quarter what PIK is as a percent of the market, and our latest print was 7% of income. So if income is 11%, 7% of that is PIK. So what would that be? 77 basis points. So there is PIK. It has always existed. It's up a little post financial crisis, but I'll let Samir, either you or Caitlin, want to talk about what you see actually going on day to day.
Sure. Happy to. Thanks, Steve. I think there's a few questions that came in on PIK too, so I'll take a quick step back. I think I bifurcate PIK into two components. One, did it start with a PIK feature, or two, was it amended to PIK, right? Did something happen where they're running into issues with cash flow where you needed to have a PIK feature? I would say, the first one, if it started with a PIK feature, that's a pretty high bar for a lender to offer to the sponsor. Generally, that's offered to a top tier credit. and typically comes at a premium to the cash spread that you would be getting if you were earning the cash interest over that period of time. The one that you really want to be worried about, is amended PIK. Amended PIK is typically when, if they can't make their cash flow, if they can't make their interest payment, you are moving some of that and delaying the payment of that. I think when you look at the CDLI, and while you read all the news about the increases in PIK, whether it's across both of these, you see it's actually come down. So I think it tells me a couple of things. So that even if the private equity firm is potentially asking for, a PIK option, out of the gate on, a top tier credit, they're not actually using it, right? And I think when you look at, okay, what is amended PIK, I think you should feel relatively comfortable, and you look at the low non-accrual rate as well, and those kind of move hand in hand. I think it's important to bifurcate those, but I think when you see it coming down over the last couple of quarters, that's really what you're seeing. But I also think in the market today, lenders are willing to offer PIK components, on the new assets. Samir, if you want to add anything else.
Yeah, two things that really quickly agree with everything Caitlin said. One is, if you look at PIK as a percentage of total income, so the use of PIK, which is what Caitlin was referring to, what you want to watch for is, has that gone up, has that gone down, and specifically in the worst credits, because that's where it is an indicator of losses, future losses. But if you just look at some more simplistically, PIK as a percentage of total income today is at the same level it was 2020, 2021, 2022. So it's not gotten worse. To Caitlin's point, on the best credits, maybe more loans have the ability to PIK. A lot of that is new originations, where lenders and private equity firms are adjusting to this new higher rate environment and allowing for the best credits, you can PIK. If you do PIK, you're going to pay us more, and we're going to have more protections around it. But my point is PIK as a percentage of total income in the CDLI is mostly unchanged in the last 4 years. What's increased is the number of borrowers that can do it.
So let me ask you both, on a scale of 1 to 10, where 10 is you're very fearful, 1 is you really don't worry about it. Today, where would you what number would you assign your concern about PIK?
I would say 2. I think if you partner with the right managers, it should be a 1 or a 2. If you partner with the wrong managers, it's going to be a lot higher.
Caitlin?
Yeah, I'd probably give 2, 1 or 2.
Okay, thank you. So let's move to M&A volume. So basically, M&A deal flow has been very low, really almost 2 years now, is it? And it's starting to pick up, but very, the perception is it's very slow. I haven't seen the most recent statistics. So I'll start with you, Samir. What is your sense today of where M&A volume is, and where do you think it'll be over the next 6 months?
I think M&A is going to pick up fairly meaningfully. I don't think it'll turn into 2021 again. The reason I think it's going to pick up meaningfully over the last 2.5 years, though, they always say what you want about the administration, but this administration will encourage M&A. You have that. You also have the idea that in the last 2.5 years, not only have private equity firms not been able to transact at prices that they want to transact at, so they've had to get a little bit more creative on returning capital to LPs. They can only do that for so long, right? There's pent-up dry powder, and there's pent-up necessity for sales. You have those drivers, and you have a more friendly administration. Those are probably the 3 biggest reasons why right now, going in the next 6-12 months, there are actual good signs that M&A will pick up versus a year ago and a 1.5 years ago when people were just hoping it was going to pick up.
And Caitlin, anything to add?
Yeah, I'd say I also look at the current portfolio, and everything you read, and when you're talking to sponsors, 70 to 80% of the private equity firm's portfolio has been in the ground for 4 or more years, which tells me they've held on to these assets for slightly longer. They've done a lot of acquisitions, which we've benefited from, seeing a lot of incrementals, which I think all lenders like to see. It makes a better business. But at some point, they've got to return that capital. And then, one kind of anecdote is just talking to a lender even earlier this week. They saw the most deals that they've seen at their investment committee in, I mean, even above 21. I agree with Samir, though. I don't really think it'll go to that. But, for instance, we're already starting to see volume come in, even on our own funds, where we're saying, instead of reviewing maybe, 5 to 10 deals a week, it's almost double that. And I think that doesn't seem to be slowing down for year end. None of these transactions will close by year end, but it seems to be a pretty strong tailwind going into the first quarter.
All right. So in terms of M&A volume, would you say it would be historic average, remain below, or above historic average for 2025? Samir, Richard?
I would say historic average with a slight lean to above average, just because there's a lot of pent up demand.
Caitlin?
I'd say above.
Last point here, credit spreads. So basically we had, correct me if I'm wrong, but credit spreads were pretty narrow in 2021, and they blew out in 2022, closer to 7. And then since that time, they've started to move inward. We seem to be back to 2021 levels. How would you characterize the direction of spreads in going into 2025? Caitlin?
Yeah, I think in general, markets kind of stabilized. They've definitely come down, but I don't think it'll go, much lower. And if anything, we're starting to see, things flex back up, meaning maybe the private equity firm asks for a loan at, SOFR 475. Before, especially when, volume's lower, people are willing to stretch and do that on better credits. When volume starts to pick up, you start to see, credit spreads also pick up, right? It's just basic supply and demand. And so I think you'll start to see that happening. I think we even have, there's probably a handful of deals in the last 4 weeks that we've seen where, enough lenders said, no, I don't want to do this asset below SOFR 500 and walked away. I think you hadn't seen that before. And I think that gives me, comfort that in reality, it's still operating in that same band of about 150 to 200 basis points, frankly, that we've seen for the last decade plus.
Thanks, Samir. Anything to add on to that?
No, I agree with that. In short, I'll add one more thing. It's a much lower factor, but I think the spreads will stay where they are or potentially increase because of what Caitlin said, because M&A is going to pick up and create more options, create more funnel for everybody in direct lending. The other thing that's different about next year versus this year for 4, 5, 6 months, the BSL market came roaring in and outcompeted direct lenders because they needed the volume for CLO creation. That is more stable today. There's not a large influx. So that's the other factor that could lead to higher spreads next year.
Good point. Wish everybody happy holiday season to you and your families. You'll probably hear from us again second, third week of January when we do our annual asset allocation webcasts. So until then, have a great holiday season, and thank you for joining.